The federal government continues to defend its move to raise the capital gains tax inclusion rate.
Prime Minister's latest tax hike on small businesses, farmers, home builders, and healthcare is not worth the cost. Another tax targeting the middle class by this promise-breaking Prime Minister.
We're asking the wealthiest and the most successful to pay a little bit more so we can help those who need it.
Will he reverse this job-killing tax on Canadians?
Conservatives stand with the wealthiest. We stand with the middle class.
Recent data from the Angus Reid Institute found that 1 in 5 people believe that the government's change to capital gains will cause their after-tax income to be reduced over the next 5 years. That's despite the federal government saying it will only increase capital gains taxes on 0.13% of Canadians in any given year. Jennifer Robson is a program director and associate professor of political management at Carleton University, and she joins me now. Jennifer Robson, thanks for coming in.
Thanks for having me.
Okay, so the capital gains inclusion rate. Not a simple thing to understand. The government says it's going to solve a bunch of problems, but not actually be that expensive. The Conservatives say it's going to hammer absolutely everybody and destroy the economy. How are ordinary Canadians going to be affected by this?
Right. Most ordinary Canadians are not going to be impacted at all. Most Canadians in a given year are not going to have any capital gains. Those who do, usually capital gains, average capital gain Canadians claim about $3,000 to $4,000. Nowhere near this new threshold that they're bringing in, right? There are going to be some Canadians, probably about 3 to 4%, who are ever impacted. Those are people who suddenly see over their lifetime, right? Those are people who see sort of a one-time sudden windfall gain, right? Sadly, normally associated with somebody in their family passing or maybe selling, sort of a second property, that kind of thing. But the vast majority of people who are going to be impacted by this are think about the repeat customers of capital gains. They're pretty high income. And they're going to be, a very small percentage of filers who are.
Okay, so when Chrystia Freeland says it's 0.13%,
she's talking about
about the annual base. So this could be people. The tech sector is very upset about this. They pay a lot of people in stock options that when they vest and are taken, that would be the kind of capital gains we're talking about. But we're talking about very high income eurners when we.
Yeah, look, when Freeland says, uses that figure of 0.13%, she says that they have an average annual income of over $1 million. So yeah, these are really, quite high income earners. When you look at who actually claims the overall capital gains, like I said, there are going to be some people, about 3 to 4% of us, who ever in our lifetime claim it, but the vast majority are pretty rich.
Okay, so let's walk through that because the polling from Angus Reid says 20%, 1 in 5, and the reality is it's less than 5%, more like 1 in 20 or less that are going to be affected by this. So you said the most common example is that a parent passes away and you inherit the family home. Is that the sort of thing you're talking about here for when a person could deal with the capital gains? How would that go?
Right. Okay, so let's set aside the family home issue, right? Because normally principal residences are always going to be exempted. But say somebody passes away and there was a family cottage, right? Right? Yep. So that could be sort of a scenario, right? So let's imagine that you're a very average Canadian. You are going to be looking at, depending on how much that cottage sells for relative to what you paid for it. It's only that difference in between that's your capital gain. But the amount that is going to be over $250,000, you're going to see a higher inclusion rate. You're going to have to include 2/3 of that income in that 1 year that you claim this. So this is not sort of like you have to pay 66%, right, on the total capital gain.
Which is how some people are seeing it.
Some people are unfortunately seeing this. And I get, look, our tax system is complicated. And, most people who don't have to deal with this stuff on a regular basis, I'm not surprised that a lot of people think that they're going to be impacted by this when they're actually not. And a lot of people, they don't get access to the kinds of fancy tax advice that the ultra wealthy do that still give them a lot of different ways to plan for this, to move the money around, to redistribute, depending on their circumstances. So I'm not surprised by that Angus Reid finding.
Okay, so if someone inherits a family summer home or cottage, cabin as we'd call it back home, the first $250,000 in profit on that is at the old rate, and it's everything above that.
Yeah.
But you have people, for example, in the private sector who don't have pensions or they're small business owners and they've invested in rental properties that they are building as a retirement nest egg.
Yeah.
Assuming they can't take advantage of complex tax planning to sort of move things around and shelter it, they just sell these assets, say 2 rental properties, they're going to be worse off, right? So it's not as benign as the government says, but not quite as malignant as the Conservatives say. How does it affect someone like that?
Yeah, so let's imagine a scenario, they sell it off, but they're a business, right? Like
Right.
they've had these properties in their business. Well, they're actually going to be impacted immediately on the first dollar because the inclusion rate is going up for all small business or for all
Right.
businesses, right? So they're going to include more of their capital gains now in their taxes for that year. But they're also going to benefit from a better lifetime capital gains exemption. So, the first one, over 1 million, 1.25 million now is totally exempt, totally tax-free.
Right.
That's not unimportant in these situations. There's also opportunities for them, for example, to time the sale, right? Sell off one property, perhaps recover the gain over a period of time to avoid triggering, right, the large threshold. So anyway, there are lots of different ways and lots of strategies. I agree with you, right? The fancy tax advice is normally reserved for the ultra wealthy,
Right.
but even a short, internet search will find you a lot of these ideas.
Well, let's use that specific example. Say David Cochrane Rental Holdings is a company,
Yeah.
and I have 2 properties in that, and I sell them for less than $1.25 million in total profit on these rental properties.
Right.
I'm exempt from capital gains on that because they're a corporation, right? Okay.
Yeah.
So this is the thing, because where most Canadians are never going to be affected by this. Most Canadians do not have an understanding of this the way they would a GST cut or an income tax cut.
And why would they, right? This is such a rare occurrence for most Canadians in terms of their tax situation. Why are they going to spend the time to try and learn the minutiae of all of these things?
Okay, so that's ordinary individuals.
Yeah.
There have been concerns. There's doctors who are incorporated, and they start paying it on that
Yeah.
first doctor, and they would have to avail of that fancy tax advice we talked about to avoid that. The tech sector is particularly concerned because they pay people in stock options,
Yep.
and a lot of them are startups, and there's no guarantee that that's going to pay off. But when it does,
But it's
boy,
a risk.
that's
Sure.
a big cash.
Sure.
But the argument is that this is going to make capital more expensive. It's going to make it less lucrative, more risky, and that's going to lead to potentially capital flight. It's going to go somewhere else
Right.
where there's a lower tax rate. How should we assess those warnings?
Well, look, it's got to go someplace else where there actually is a lower tax rate. And, so far the Department of Finance is saying that the effect of this change is actually not going to impact Canada's overall competitive advantage when it comes to other jurisdictions in the G7. We will still have a comparatively low tax rate when it comes to business in this country, right? The other thing too is that, remember, the holders of that capital, where they live matters to them, and
It's sticky.
Place is sticky. Where you start your business is also probably, where you have your friends and your family and your kids in school. And so giving all of that up and just saying, that's it, I'm picking up and moving out of the country is not a straightforward proposition for an awful lot of people.
Is there clear data on this? People point to when Paul Martin, Brian Mulroney raised the inclusion rate, Paul Martin lowered the
it.
inclusion rate, and there's a whole series of other tax changes made by Paul Martin to sort of make things more competitive here economically.
Yeah.
Can you unspool the data and say, lowering the inclusion rate unleashed this amount of economic growth? Like, how do we come to a sort of a factual conclusion on this?
I know. There's the literature on this stuff, the research on this stuff. Number one, it's really hard to do because there's so many moving pieces. And like I said, so many different considerations, especially when you're talking about, tech sector and incorporated people and so forth. But look, and I've got this posted on my my Twitter thread, and happy to bump it up into the thread again so people can find it more easily. When you just look at the data of people coming into Canada and people migrating out of Canada, the line moves up and down, but it doesn't move up and down clearly in relationship to changes in capital gains policy, right? So, I mean, look, that's not sophisticated causal analysis, but normally we would sort of see some kind of response, especially when the capital gains has moved up and moved down. We would normally like to see some response with regards to just that simple kind of graphing one variable against the other.
Right.
We're not seeing it. We're not seeing it so far.
Okay, I have one last question for you. The defenders of this move say that the primary effect of it is small. The critics of the move say the secondary effect of this. So, for example, if I'm a small business owner and I'm incorporated, I may be able to find ways to mitigate the impact on me, but it might change my hiring policies. It might change the salaries I give my particular employees. What do we know about the knock-on effect of this sort of thing in terms of hitting corporations?
We have anecdata, frankly, is
Right.
largely what we've got on that front. And, to come back to your example in the tech sector, this is probably going to prompt some challenging conversations around the optimal way to compensate your employees and to retain talent, right? and maybe that's going to require, you know, some complicated planning and hard conversations between business owners and the people that they employ. You know, I don't envy them that, right? Those are difficult and challenging kinds of plans to revisit, and especially when you've kind of been running things, you know, under certain assumptions, and now suddenly the world has shifted. I get it. That's, you know, that's an unwanted change.
So this is an immediate political controversy. Short-term, medium-term, long-term, is this an economic problem?
So there have actually been some really good studies on this. The changes on capital gains inclusion rates are not shown to have a negative impact in terms of, you know, productivity, investment, savings, and so forth. So over the longer term, I think, look, the economy will find a steady state again. You know, this is a relatively small tax increase at about, you know, $3 billion a year, which is less than 1% of overall government revenues. So this is, you know, this is not going to sort of like suddenly change the fiscal picture for the government, or fundamentally, you know, completely overhaul the entire Canadian economy.
Professor Jennifer Robson at Carleton University, thank you for your time today.
Thank you.